Hello and welcome back. US earnings season is not over yet, but it's provided quite a lot of information and a few surprises. Bonjour, François Savary.
Hello, Mark.
Thank you for joining us. Nice to see you. What is your takeaway so far from US earnings season?
I would say that you have two elements that are important. The first one is that when you look at the number, you have very solid number in terms of beats. You have 77% of the companies who beat the forecast estimates. So, I mean, it's a very good earnings season. And the numbers, I mean, the EPS growth is quite satisfactory, around 15 to 16%. It's above the consensus. So very good news on that front is that the US economy is bringing earnings, so it's very good in terms of the potential for the equity market down the road. One element that also needs to be put forward is the fact that the Magnificent Seven had kind of mixed results, and you had some news that were, in a way, again, bringing back the issue of is it going to be possible to monetize the AI story? And I think that is very interesting considering the fact that you had the DeepSeek shock that happened in January. So in a way, the reaction of the Magnificent Seven has not been that good in the course of the last few weeks, I would say, because there is this issue of is it possible to monetize AI that is really coming in the mind of people.
Well, on that subject, then, for instance, manufacturing PMI has become positive for the first time for a few years. What does that tell us? And is that a surprise to you?
It's not necessarily a surprise, you know, the industrial sphere, the goods sphere of the US economy has been weak in the course of the last, I would say, 2.5 years. What was very, very strong was the service activity. So you are right. What is interesting is that the manufacturing sector is going back to growth, to expansion. But in the meantime, you need also to consider the fact that the service side of the economy has weakened more than was expected. So to my point of view, there is a redistribution of economic activity that's quite possible, but it doesn't change the scenario that there is a slowing down of the US economy that is going to materialize in the course of the next few quarters. So I would not change my scenario on that. We are going to go to see a slowdown in US economic activity, but it doesn't mean that we are heading towards a recession.
Nevertheless, bearing that in mind, with what you said about the big tech stocks and what we've just discussed about manufacturing, does that mean we should be repointing our portfolio in different ways from the last 2 years, for instance?
Yes, that's something that I have done and that we have done in portfolios. We have reduced the exposure to the AI and technology theme. I think that, you know, when you consider a portfolio, if you have an exposure, I would say a passive exposure through ETFs, don't forget that the Magnificent Seven represent more than 30% of this index. If you add a stock selection on different Magnificent Seven, you add that. Plus, if you have exposure to, for example, QQQ, which is the pure technology ETF, it's too much from my point of view in current condition. It's too much exposure to the technology and AI themes. So this is the reason why, first of all, we have created position in December into equally weighted ETF S&P 500. And this is also the reason why we have taken some profit on the very strong gain on the Big Seven. The idea, and you are right, with the manufacturing coming back to life, it's really the story of the ability of earning growth to spread out of the technology into the other sector that is at play. And I think that it is what you need to have and to adjust your portfolio for.
So you're saying there's going to be a trickle-down effect from high tech now into real estate that could be effective over the next year, for instance.
Please, this is the way I want to be positioned. I want to increase my exposure of stocks out of the Magnificent Seven.
You mentioned services. You called financials correctly just a few months ago. It happened immediately. Financials in the S&P, the components of the S&P that are financials, they've massively outperformed the rest. They're the biggest winners this year so far at 7% growth. What are your thoughts on that? Do we still hang on to financials? Is this something that's going to play out for the rest of the year?
To hang on to them, yes, I would say so. And when you look at the number were quite stellar, the number they published, and it's connected to the fact that market activity has been quite good. And you still have also in front of us, you still have the prospect that you will have an increase in any deals. IPOs could make a comeback in the coming months. So there are different factors that could support the investment banking business. And I think that to stick with the financial is a good solution, not only in the US, by the way, but also in Europe, where I think that they can benefit for different reasons, but they can benefit too. So yes, I stick. It doesn't mean that you cannot take some profit because, as you said, in the very short term, the rally has been quite strong. It depends which kind of investors you are. If you are more of a tactical player or if you want to play the strategic, if you play the strategic allocation, you can keep your financial in your portfolio.
With the effect of trade tariffs still to be felt, I imagine, and so far it's really, well, it's only, I say only, but it's on China for the moment, rather than being on everyone else as well at the same time. Do you think, bearing that in mind, the numbers, the CPI numbers today and tomorrow, isn't it? CPI today for January and PPI tomorrow for January. Obviously, traders going to be riveted to their screens today.
That's quite sure, but I would, in a way, if I may correct your remark about the tariff, when you look at what was done on steel and aluminum, it's global. It's 25% tariff on everybody all around the world, and this is the reason why you had the reaction yesterday of the European Union saying that they are going to take some countermeasures and that this is not acceptable. So yes, you are right. Global tariff 10% for China. 25 for Mexico and Canada subject to negotiation, and then you have the sectors, specific sector. Today, 0.3% expected by the market on the CPI, the fifth time in 6 months that you will have such a number. If you analyze that, it means that the CPI is not at levels that the Fed wants to see, clearly. And that's exactly what Mr. Powell said yesterday. Mr. Powell said yesterday that they are in no rush to cut interest rates. And again, it fits into the scenario that we developed in the course of the last few weeks, which is to say, to our point of view, there won't be any rate cut in the US before July of this year at the earliest. Because now you will see if the trade issue comes more and more in front of us and the tariff issue comes more and more with a decision by the Trump administration, then we will see if there is an impact on prices. My guess is that there will be an impact and that it will bring the Fed to a standstill in terms of monetary policy and maybe postpone even a rate cut by July to September or the last quarter of this year, depending on economic activity.
Retail sales Friday. Any thoughts?
Very interesting because retail sales are very interesting. Consumer is the biggest part of the biggest explanation of US growth. We all know that, and it was in the news in the course of the last few weeks. You have an increase in the default rates on credit cards. You can see that some low income consumer are using more and more their credit cards. It means that their wealth is not enough to support the consumption. So yes, retail sales is a very, very important factor. We want to take a look at that very closely.
Coming to gold. You called gold at 3,000 for 6 months now, and you got that totally right. We're virtually there. What do we do now? Do we take profits? Do we hold on?
We hold on if you look again, if you are a tactical player or if you are a strategic player. If you are a tactical player, I think that the gold price is overdone in the very short term. We move across the line, the 2,900 line. Gold price is, you can say, overbought. There is overvaluation or overbought condition on the gold price. What is interesting is that I think that the fact that we crossed the 2,800 in the course of this recent rally is telling me that now this level will remain a support. So there is not too much to be feared in terms of setback for the gold price. I will stick with this idea that you need to have a good position in gold in your portfolio. Uncertainties are not going to decrease in the course of the next few months. Clearly, people are looking for safe haven. You don't have that many in the world. And what was interesting is last week, there was the publication of the numbers of gold purchase by central bankers and etc. that was published by the end of last week. Interestingly, the numbers were much higher than expected. So it really means that the story about central bankers trying to diversify their reserve currency exposure out of dollar into gold is still at play. So for me, as a strategic investors, I keep my exposure to gold and I do not recommend individual to sell position and to take profit.
Coming to Europe now, Kering yesterday announced their report. Is there anything to take away in particular from that report yesterday?
You have two or three things that you can take not only for the report but from what happened in the course of the last few days. First of all, clearly they decide to fire their the artistic director, which was in place for only 2 years. It means that the recovery they were expecting through the help of this guy is not functioning. So it means that there is a problem still at how they are going to turn around Gucci, which is the bread and butter of Kering in the thing. So that's the first thing. It means that the end of the road is not in front in terms of the recovery that Kering needs to go through. Second elements to take, the number yesterday were not good, but they were less bad than expected by the market. So maybe you have the green shoots that something is happening in terms of the profitability of the company. But nevertheless, down the road, everything concerning Kering relies on the ability to find back the magic when it comes to Gucci, which is the bread and butter of the company. And for the time being, they have not reached that level. So we will watch the company. It can be a turnaround story for the medium term, but it's still in a difficult position for the short term.
I think I'm right in thinking that Gucci reduced the price of its bags last year. Have we seen the effect of that yet? And in the numbers that were announced yesterday? And what does that say for the rest of the luxury industry?
I am not able to tell you to answer your question. I'm not able because I didn't go that deep in terms of the Gucci numbers about the price of the bags. But what is very clear, the leather part of the luxury business is clearly a central piece in what you can expect in the medium term because the margins are quite high. And this is where in the course of the last, let's say 15, 20 years, big luxury groups have developed significant part of their business and profitability. Yes, you had some question about the ability of those companies to sustain and support the increase in prices that they did in the course of the last 3 years, because the price increased significantly. There were some articles about Chanel, increasing the price of their bags quite significantly in the course of the last few years. There is one exception at the end of the day. It still remains Hermes. Hermes is still able to increase the price of their leather good bags because really there is a demand that is connected to the you want to own a Birkin or a Kelly bag, and but the other one are suffering. The other one are suffering.
Is this the what is your thoughts on the luxury industry as a whole? If there was an ETF on it, and I know there are.
Okay, I think that we talk about the luxury, I think by November, and I said at the time that I was in condition that maybe it was interesting to push it. The rally on the luxury stocks have been quite significant. When you look at Hermes, which I quoted earlier, Hermes is at the historic level, highest level ever, 50. Remind that in November it was trading at around 1,900. It's a significant move. The same thing, not to the same extent, can be said about Louis Vuitton. Burberry has been able to provoke a positive surprise. Kering is still in the doldrum for the time being, but nevertheless, the luxury business is facing a lot of challenges. I still think that in the very short term, there I would take some profit. If you had made some solid entry point in November, I think that there is room for, because it's not going to expand at such level. It's not going to continue. The uptrend is not going to continue to the same extent in the future. You could book some profit. At the end of the day, when you look at the strategy, if you have an equity exposure in your portfolio, you had, as I said, for example, solid result or solid profit on AI stocks or technology stocks. Luxury lately has been good. You want to reduce a little bit your equity exposure to reduce your risk in your portfolio. So AI is a potential candidate. Luxury, if you have purchased them in November, is another candidate to reduce your total risk.
Francois, I think that's all we got time for. Thank you very much indeed, and speak to you next week.
Okay, have a good week. Bye bye.
You too. Bye bye.